Prashtaji, can we begin?
Yes, they start.
Yes.
Oh, sure. Good afternoon, everyone, and welcome to this amazing 3 days direct tax relearn series in corporate taxation. We welcome all of you. Before we actually start the program, I request to the backend team to kindly play the ICI motto and requesting everyone to please place your hand on your heart.
य एषः सुप्तेषु जाग्रति य एषः सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you so much. Let's just begin the program. I'll request we have CA Ketan Sayyad sir, the treasurer of WRC of ICI with us. I'll request Ketan sir to kindly give your opening remarks.
Thank you, Rudesh. Both the faculties, Dhaval bhai, Gopal ji, and all the members who have joined this program. Very good evening to one and all. This is second relearn series which we are today starting. The first one relearn series was on individual and non-corporate taxation, which we had in the month of July, and this is the right appropriate time to relearn the taxation relating to the corporate. And all 3 days we are going to have wonderful speakers and the very good topic selected for all 3 days by the committee. So today we'll be, having both learned speaker Dhavalji and Gopalji deliberating upon the new regime, old regime, and also the minimum alternative tax provisions. So basically, the format of this entire 3 days will be, we'll have this 1.5 hour, 2 hour deliberation by the speakers, and then we will keep the session open for the solving members' query, which practical queries which they are facing while filing the return. This being season of filing corporate tax return, and we are encountering a lot of practical difficulties. So we have requested both the faculties that post these deliberations. They will take up the questions, and these questions you can post in your chat box. With the permission of the speakers, all 3 days we will circulate the PPT which will be given by them, and also with their permission and ICS permission, we will host the recording on the WRC web portal. With this, let me once again, welcome all of you, and let me thank Gopal ji for, readily agreeing when I contacted. In fact, it was late on my part to contact him in the last week only, and he readily agreed. Gopal ji, really thankful to you for sparing your valuable time for WRC, for ICAI. Thank you so much. Over to you, Rudesh.
Thank you so much, Ketan sir, for your opening remarks and setting the base and start of this amazing second direct tax relearn series. Let me give you a quick introduction of our today's speakers. CA Gopal Bohra, a bachelor degree in commerce from the Ajmer University and qualified as a chartered accountant in 1998. And he has also completed his visa. He's a partner at Anisha Associates LLP with nearly 24 years of experience in direct tax. He has advised a number of in companies on corporate income tax matters, including international tax matters and transfer pricing. His area of expertise include direct tax compliance, litigation, direct tax advisory on domestic and cross-border transactions. He has given presentations at WRC, CTC, and a regular contributor in WRC on topics relating to direct tax. Our another speaker is CA Dhaval Selwadia, a partner at Anisha and Associates with nearly 28 years of experience in the field of direct tax, international tax, statutory audits and tax audits and other services. He's advised a number of companies on corporate income tax matters, including international tax and transfer prices. Again, his expertise includes direct tax compliance litigations, direct tax advisory on domestic cross-border transactions, and transfer pricing. He's contributed articles in Tax Sutra, CTC, BCAJ, WRC on topics relating to direct tax. I think we have one of the best faculties today guiding us on today's topic in direct tax relearn series. Thank you so much, Gopalji and Dhaval sir, for being there. We have CA Kajal Chande as a coordinator also who will be coordinating this session. And thank you so much, participants, once again. I request Gopalji and Dhavalji to kindly take this session ahead. Thank you, sir. Over to you. Sir, you're on mute. Gopal, sir, you're on mute.
Sorry. So thank you, Radesh bhai. Thank you, Ketan bhai, for giving this opportunity. And we will try to cover the provisions relating to the corporate tax, which cover under old tax regime as well as MAT and the new tax regimes. So between me and Dhaval, so what I will do, I will cover the old tax regimes with MAT, and Dhaval will take over on the new tax regimes and the new manufacturing company. So then we can, and we will try to complete this in 2 hours, so then we can have sufficient time to attend the question answers. So though the topic is very wide to cover in 2 hours, but we'll try to sum up into the, so maybe initial 45 minutes to 1 hour, I'll take it on the primarily on the MAT, and then Dhaval will take it over on the new tax regimes. 1 minute. The screen is visible?
Yes, sir.
It is visible, sir. Correct. We can.
Yeah. Okay. So as I mentioned, today we will cover the taxation under old regimes, which include your normal taxation and tax under MAT, and the tax under new regimes, which primarily cover section 115BAA and 115BAB, which is popularly known as the new tax regimes. So first under old tax regimes, so the companies are required to compute the tax under normal provisions of the Income Tax Act. So the rate of taxation under normal tax regime is if the turnover of the company in the preceding financial year 21-22 is less than 400 crore, then they are subject to tax at 25%. But if the turnover in the preceding financial year 21-22 exceeds 400 crore, then they are supposed to tax at 30%. So when we compute the normal income, so there are various deductions which are available under the old tax regimes. And so the normal depreciation, plus there may be an additional depreciation. There are certain deductions which are available under Chapter 6A, let's say ATIC, ATIA, ATLA. There are various deduction ATG, including ATGGA, which are available to corporates, which are governing under the old tax regimes. So when you compute the total income, so first you have to take the net profit as per profit and loss account, and then you claim the deductions which are available under the act, which are either additional depreciation, maybe your 35(2)(ab deduction. So now, of course, the weighted deduction under old tax regime is not available. But if you are into the certain specified industry, then you can claim 100% of the capital expenditures. So, and once you compute the income, then on that income, you
How
have
many of you are not aware? Now you.
So having computed the total income, then you have to apply the rate of taxation. So as I said, if the turnover is less than 400 crore, the rate of tax will be 25%. And if the turnover exceeds 400 crore, then the rate of taxation would be 30%. So the effective tax rate under the companies, for companies less than 400 crore, the effective tax rate is 29.12%. and companies with turnover above 400 crores, the effective tax rate is 34.94%. And then you have to compare the tax which is payable under Section 115JB, which is popularly known as a tax on book profit. So currently the tax on book profit is 15%. So you have to compare whether the tax which is payable under normal provisions, which is computed after claiming all the deductions and benefit, whether the tax exceeds the tax of 15%, then you will be paying tax as per normal income tax. If the tax is less than 15% of the book profit, then you will have to discharge the tax liability under 115JB. So which is a tax on book profit. So the effective tax under 115JB comes to 17.42%. So this is the basic background, like when you compute, like how you will compute the tax under normal provision and then to shift to the MAT. So what I will do now, so I will cover the what are the items which has to be considered while computing the book profit. I'll give the background of the why the MAT was introduced and all. So the objective of the MAT profit, as I mentioned, when the government wanted to boost the industry, they have introduced various exemptions, deductions to the industry. And because of that, what happened? The companies were making a good profit, but because of exemptions and deductions, the taxable income either resulting into zero or very negligible, though they may be declaring huge dividend to the shareholder, but they were not paying tax. So the government felt then it is the interest of the government to introduce some mechanism whereby they can collect the minimum tax. So that is why in 1987, they have introduced the MAT provisions. So that point in time, the tax under MAT was 30%. And then in 1990, the provisions withdrawn by the government, and then again reintroduced by way of Section 115JA in 1996. And currently it is under Section 115JB, where we are paying currently the tax rate under MAT is 15%. And the companies which are situated or located into the International Financial Service Center, the tax under MAT is 9%. And when you compute the tax under MAT, the law required that companies are supposed to submit a Form 29B, which is from the Chartered Accountant, to be submitted before filing the tax return. And of course, the provisions of 115JB may not be relevant for the companies which are opting tax under Section 115BAA or 115BAB, which is popularly known as new tax regime. So once the company opt for the new tax regimes, then they are out from the MAT provisions. So then the next questions comes, like this provisions of MAT is applicable to what type of companies? So the first, it is applicable to all the domestic companies, whether it is private limited company, whether it is limited company, it is applicable to all domestic companies except the life insurance companies to whom this provision is not applicable. And it is also applicable to certain foreign companies. And certain foreign companies are excluded from provisions of the MAT. And as I said, the companies which are opting under the provisions of Section 115BAA, 115BAB, this provision is not applicable. So now when we are dealing with the foreign companies, whether the provisions of Section 115JB is applicable to foreign companies or not. So previously this issue was highly debated. So there were the ruling of the Authority of Advanced Ruling in Castleton, where it was held that the provision of Section 115JB is applicable to even foreign companies also. Then there was a contrary position was taken by Delhi Tribunal, saying the provisions of Section 115JB is not applicable to foreign companies. And then government felt it is necessary to bring an amendment to the section. So then they have introduced explanation 4 and explanation 4A to Section 115JB with effect from retrospective effect from 1st April 2001. It was introduced through the Finance Act 2016. So what the explanation 4 provides? It provides like foreign companies to whom it is not applicable. So the foreign companies which are resident in a country with which India has entered into a double tax avoidance agreement, and the company does not have a P in India, to that those foreign companies, this provision is not applicable. So it means if where the India has entered into double tax avoidance agreement and the foreign company does not have permanent establishment in India, they are out from the application of the provision of section 115JB. But if the company constitute permanent establishment in India, then those are subject to the provisions of minimum alternate tax. The second category, where the India does not enter into double tax avoidance agreement, but the companies are not required to obtain any registration under any law in India, those companies are also excluded from the application of the provisions of this section 115JB. Then explanation 4A to section 115JB, which inserted from by the Finance Act 2018, provides that MAT provision shall not be applicable to foreign companies whose total income comprises of profit and gains arising from business referred to in section 44B, BB, 44BBA or 44BBB, and such income has been offered to tax at rate specified in those sections. So if the foreign companies which are governed by these sections and they have offered to tax their income at the rates specified in the respective sections, those foreign companies are also exempted from application of the provision of section 115JB. But the question still arises whether though this amendment has been made and the companies which do not constitute permanent establishment, those who have permanent establishment in India can still be governed by the provision of section 115JB. So recently there was a Bombay Tribunal judgment in which the Bombay Tribunal said that if the foreign company, though they have permanent establishment in India, MAT provision is not applicable to them because they are not required to prepare their profit and loss account, which are supposed to be led before the annual general meeting. So for them, the provision is not applicable, but this issue is still debatable. So now coming to the meaning of book profit. So what does it mean by book profit? So the book profit is defined in explanation 1 to section 115JB, which says book profit for the purpose of section 115JB means net profit as shown in the statement of profit and loss account prepared in accordance with schedule 3 to the Companies Act 2013 as increased and decreased by certain items prescribed in this regard. So when you have computing the MAT, so you have to take the profit, what is the profit which is prepared as per schedule 3 of the Companies Act 2013. That will be the starting point. And then there are certain items which has to be added with the book profit or which has to be reduced with the book profit if those items are included in the profit and loss account which is prepared as per schedule 3 of the Companies Act 2013. Then the important point is how the profit and loss account to be prepared. So the law mandates the profit and loss account should be prepared as per schedule 3 of the Companies Act 2013. And of course, in case of electricity company or banking company, it can be in accordance with the provisions of the law governing such companies. So if there are separate law which governs the banking company, then they are supposed to prepare the profit and loss account as per the law applicable to them, or similarly with the electricity company, because they may not require to prepare the profit and loss account in accordance with schedule 3, but they are excluded. So for them, while computing the MAT, we have to adopt the profit which is prepared as per the law applicable to such company. And while preparing the profit and loss account, the accounting policies, the accounting standards, and the method and rate of depreciation, which has been adapted for the purpose of preparing such accounts laid before the company, has to be similar while preparing the 115JB also. So just to give an example, like if the company prepare a profit and loss account which it present before the annual general meeting, the same accounting policy, same accounting standard, and same method and rate of depreciation should be adopted while preparing the profit and loss account for the purpose of computing the book profit under section 115JB. This provision was introduced because the government felt that companies may evade the taxes by following a preferential accounting policy or maybe a differential accounting depreciation rate. So that is how the government felt it is necessary. So they specifically provided in the act that the P&L account shall be prepared as per the accounting policies, accounting standard, and accounting method and rate of depreciation, which has to be the company will present before their shareholder in the AGM. And similarly, like those companies which are following a different financial year, so let's say the subsidiaries of a foreign companies, which may follow the December year or calendar year for the purpose of presenting before the shareholder. So, but for the purpose of computation of book profit, they are required to prepare the profit and loss account for the financial year. So they are also supposed to maintain, prepare the profit and loss statement in the same manner what it follow what when it present before the shareholder. So though there may be a different calendar for shareholder, there may be a different financial year, but for tax purpose, they have to exactly follow the same principle. So as I mentioned, while computing the profit, the starting line item is the profit as per profit and loss account. Then there are certain items which to be added and certain items which are to be reduced from the computation of book profit. So now let us deal what are those items which has to be added while computing the book profit if those items are debited to the profit and loss account, and items which are to be reduced while computing the book profit if those are credited to the profit and loss account. So the first item is income tax paid or payable and the provisions thereof. If any income tax or provision for income tax, if it is debited to the profit and loss account, then you are supposed to add back that item while computing the book profit. And explanation to section 115JB defines what is mean by the income tax. So the income tax include tax on dividend distribution tax, which is payable under section 115O or section 115R, or the surcharge, higher education says, etc., also form part of the income tax. Similarly, if any income tax, whether it is section 234A, 234B, 234C, or even TDS on interest on delay in deposit of TDS, which is under section 200, also to be added back because that is also included in the definition of income tax. But of course, there if any penalties or anything which is levied under any other law, that should not be added because that the law does not mandate for that. And similarly, securities transaction tax or commodity transaction tax, which is also not defined in the meaning of income tax, that can also be not to be added back even if it is debited to the profit and loss account. And interestingly, one of the decisions where the Bombay High Court has an opportunity to deal with an issue relating to wealth tax, whether the wealth tax is to be added back if it is debited to the profit and loss account. Then the Bombay High Court held that wealth tax is not an income tax because the language used in the explanation is the income tax. So wealth tax is not an income tax, so it should not be included. So if wealth tax is debited, then it need not to be added back. Of course, now the wealth tax is not there, but if those, in some cases, if there are earlier pending litigations are there, someone can take that as a positions. Then second item is amount carried to any reserves other than reserves under section 33 AC. So like any reserves which are created and that because of creation of the reserves, if the profit is reduced because it has been debited to the profit and loss account, that reserves need to be reversed or need to be added back while computing the book profit. So the reserves could be like dividend equalization reserves, debenture redemption reserves, or maybe investment fluctuation reserves, or sometimes it may be because mandatory requirement, somebody wants to claim the benefit of section 10 AA by further extended period, and then they necessarily has to create a reserves, and that reserves is debited to the profit and loss account, that reserves need to be added back. The third item is provision for uncertain liabilities. If any provision which is created for uncertain liabilities, that needs to be added back. Then the question arises, if provisions created for gratuity, provision created for leave encasement or warranty, whether this needs to be added back. So to answer to that, if the provision for leave encasement or provision for gratuity is made basis the actuarial valuation, so then there is some scientific basis to that. And also similarly warranty, if warranty is also created based on some scientific basis and then it is debited to the profit and loss account, such item need not be added back. But if it is all ad hoc, there you cannot explain the basis how the provision was created, then of course then that it will be treated as unascertained liabilities and that need to be added back. Then the fourth item is provision for losses of subsidiary companies. So like though the Companies Act, you cannot debit the provisions of the losses which the subsidiary companies has incurred. But assuming if such items are debited to the profit and loss account, then the question is, can those items be allowed to be deducted? The answer is no, because the explanation to this section clearly says if the provision for losses of subsidiary companies are debited to the profit and loss account, then it has to be added back. Then when I dealt with these four items which are debited to the profit and loss account, if there are reversal of those items and those items are credited to the profit and loss account, then clause 1 of the explanations provide that such amount which is withdrawn from the reserves or any provisions. So let's assume you have made a provision which was held to be an unascertained liabilities, and then subsequently you reverse it. So the reversal will not be taxable. So if such reversal is credited to the profit and loss account, then you are allowed to reduce the book profit to that extent. So that if any reversal of these items, whether even if there is a reversal of any excess provision for income tax, or if there is any withdrawal from any reserves which may be created, or maybe reversal of unascertained liabilities or reversal of losses of subsidiary also sometimes. So those reversal has to be excluded if it credited to the profit and loss account, and no benefit was taken when those items are debited to the profit and loss account. Then the next item, which is dividend paid or proposed. If the dividend is usually debited to the profit and loss account. So if it is debited to the profit and loss account, then it needs to be added back. Then the next item is expenditure relating to exempt income under section 10. Other than section 1038, now of course the section 1038 is no more relevant, because now there is no long-term capital gain which is exempt under section 1038, but still it is part of the explanation. So if any expenditures which is relating to exempt income under section 10 or section 11 or section 12 which are debited to the profit and loss account, then you need to add back. And the reverse of this, which is dealing with the income which is credited to the profit and loss account, if any income which is exempt under section 10 or in case of charitable trust section 11 or 12, if it is credited to the profit and loss account, those income needs excluded while computing the book profit. Then the next item is expenditure relating to share in AOP on which no tax has been paid. So as we all know, if any profit is distributed or by an association of person or body of individual, then the tax is suffer in there the AOP or BOI's hands. And if such tax is being credited by the assessee, then that income has to be reduced if it is credited to the profit and loss account. And if there are any corresponding expenditure which are debited to the profit and loss account, then to that extent, the profit needs to be added while computing the book profit. Then the next item is depreciation. So first, the depreciation which is debited to the profit and loss account, you are supposed to add back. Then what you will have to do, you have to compute the depreciation if there are any depreciation which is on account of revaluation of assets, is there, then you have to reduce only the amount of depreciation excluding the depreciation on revaluation of assets. This provision was introduced because what happened, people were revaluing the assets, and if because of revaluation, if you are eligible to claim or debit accelerated depreciation, then to that extent the government may lose the minimum tax because then they were allowing the depreciation on the revalued component. So that is why first you have to add back the depreciation which is debited to the profit and loss account, which may include your depreciation on revaluation component as well. But then while reducing, you have to reduce only the amount which is a normal depreciation other than depreciation on revaluation of assets. Then there is one item where, like, if you withdraw from revaluation reserve, any amount which you withdraw from revaluation reserve to the extent of depreciation account of revaluation of asset, that also need to be excluded or reduced while if it is credited to the profit and loss account. The next item is the amount standing in revaluation reserves relating to revalued asset on its disposal. So what happened if the revaluation reserves was created, so the asset was revalued. So let's just give an example. Assuming that somebody is holding an assets of 1 crore rupees, and that asset is revalued at 200 crore rupees. So let's say 1 crore rupees and revalued at 2 crore rupees. So then 1 crore goes to the revaluation reserves. And subsequently, when the asset is sold, then what happened? Let's assume that the asset is sold for 2 crore 10 lakh rupees. So in that event, it might possible that the profit which is credited to the profit and loss account is only 10 lakh rupees. But the real profit was 1 crore minus 2 crore 10 lakh rupees, 1 crore 10 lakh rupees. So that is why the government says if there is any amount standing in the revaluation reserves relating to revalued assets, then it has to be reversed it back. So on that, you have to pay tax on that amount. The next item is deferred tax. If debited, then you have to add back. If there is a credit to the P&L account, then you have to reduce the deferred tax which is created. So it can be a deferred tax assets or it can be a deferred tax liability. So if it is debited to the P&L account, then you have to add back. If it is credited to the P&L account, then you have to reduce it from the computation of book profit. Then next item, which is relating to a foreign companies. So like foreign companies, if they earn the capital gain from securities or interest, royalty, or fees for technical services. So if those tax rate, if any of those item is taxable at a rate lower than 15%, then technically what happened, the tax under MAT is 15%, and assuming the tax on any of those items, let's say capital gain on unlisted securities, if foreign company transfer unlisted securities, the long-term capital gain is chargeable to tax at 10%. But if they have to suffer tax at 15%, then it is the government felt that it is on this would be given to the benefit. So to that, what they have done, if any income, if it is credited to the profit and loss account in case of foreign company, which is comprised of capital gain on securities or interest, dividend, or royalty, and if those tax on that is taxable is at a rate lower than 15%, those items to be excluded while computing the book profit. And similarly, if any expenditure relating to such income is debited to the profit and loss account, then such item needs to be added back while computing the book profit. Then the next item is the notional loss. When in case of real estate developer, when they hold the shares of a special purpose vehicle, and the shares of SPV is being transferred to a business trust, which is for the benefit of REIT, real estate trust. And if the shares of the SPV are transferred to the business trust, so then section 4717 exempt such transfer. So any loss or any gain arising on such transfer is not chargeable to tax under section 4717. So the question arises whether such gain, notional gain or notional loss, which is debited or credited into the profit and loss account, whether that should be chargeable to tax. So previously this was initially it was a concern, then government brought an amendment, so by which they provided if any notional gain or notional loss on exchange of shares of SPV is debited or credited to the profit and loss account, those item has to be either if it is a loss, it debited to P&L account, then to that extent the book profit needs to be increased, and if it is credited to the profit and loss account, then the book profit needs to be reduced by that much amount. Similarly, if such units of the SPV which the SPV holds, if it is valued at mark to market, and if there is any loss or gain is recognized on because of the mark to market accounting, that loss or gain also needs to be eliminated while computing the book profit. So then what happens? So then only the actual gain, assuming that the unit was not exchanged, the shares was not exchanged. So let's assume that the company transfer the unit of the business trust, and then that point in time the gain, considering the sale consideration less the cost of the original shares, like before converting into the unit, that needs to be added while computing the book profit. If it is a profit, then it has to be added. If it is a loss, then it has to be reduced. So just to give an example, so let's assume that the company hold the shares of an SPV, and the value of the shares, let's assume 100, and on exchange of the shares of SPV into the business trust units, the value is, let's assume 200. So for the accounting purpose, the value, so there will be a notional gain of 100. So that notional gain of 100 is not chargeable to book profit. But subsequently, if those units are transferred at, let's say 300, the year of transfer, the 300 minus the original cost of those shares is 100. The 200 will be taxable in the year of transfer. So this is as far as the units of SPV is concerned. Then the next item is in relations to expense in relations to royalty in respect of patent. So if company which has engaged in or generating any income from the patent which is chargeable to tax at 10%, which is because the rate of tax for those companies under 115BBF is 10%, whereas if the MAT is applicable, then they have to pay tax at 15%. So the government has provided relaxation. So such income, if it is credited to the profit and loss account, which is chargeable to tax at 10%, then those income to be excluded. Similarly, if there are any expenditures which are debited to the profit and loss account, then such expenses needs to be added back while computing the taxable income. Then the next item is provision for diminution in the value of any investments. If any provisions in relations to diminution in value of investment, let's say provision for doubtful debts or provision for losses of the subsidiary companies are debited to the profit and loss account, then such item to be added back while computing the book profit. Of course, there are certain judicial precedents where it has been held that if the diminution in value of an investment is debited to profit and loss account, and simultaneously the carrying value of such investment is shown net of such diminution in the balance sheet, then such items need not to be added back while computing the book profit. So it means those items can be claimed as a deduction while computing the book profit. So we will deal that part subsequently. Then the next item is what is the one more deduction which is available, which is if in case of a company which has the brought forward depreciation and brought forward business loss, one minute. So in case of a company which is under insolvency, and or a company where because of operation or mismanagement, the central government by virtue of section 241 has appointed a new board of directors and the shareholders has also changed, then in those cases to revive the companies, the government has given a benefit that such companies are allowed to set off the both unabsorbed depreciation and unabsorbed losses of the company which are brought forward. Usually in normal scenario, the lower of the two is allowed as a deduction. So, but in case of companies which are under section 242 or which is in those cases where the resolution application has been approved by the NCLT, in those cases the both business loss as well as depreciations are allowed as a deduction. Then amount as I mentioned for other companies, if there is any brought forward unabsorbed depreciation or business loss, then the lower of the two will be allowed for set off. Then profit of sick industrial companies till its net worth becomes zero, that if it is included, then it is allowed to be excluded. So when we discuss like certain items which are to be added to the book profit if debited to P&L account, or certain items to be excluded to the profit and loss account if those are credited to the profit and loss account, then the question arises that whether the tax department can go beyond the items which are debited or credited to the profit and loss account, or whether they can challenge the computation of book profit. So in this case, the Supreme Court, in the case of Apollo Tyres, so where what happened, the assessing officer, while computing the income under section 115J, has only the power. So what the Supreme Court says, the assessing officer has only the power to examine the books of account which are certified under the Companies Act and having properly maintained in accordance with the Companies Act. So the AO cannot change the accounts which are audited or certified by the auditor. The AO has only limited power to examine whether that items are additions and reductions as provided in the explanations are being factored or not. He cannot change the profit and loss account which are certified by the auditor. So that while dealing with, when we discuss the profit and loss accounts, so there are various decisions where they held that the profit and loss account need to be read with the notes which are forming part of the accounts. So you cannot read the profit and loss account only what is debited or credited to the profit and loss account, but if there are certain notes which are forming part of the notes to account, so when you read the profit, then you have to read with the with those notes. So now what we will do, we will discuss some of the items which are dealt by various courts. So one interesting point was that if any items which is, even if it is credited to the profit and loss account and is of a capital nature, or which is not taxable transfer under section 47, let's say when there is a transfer from holding company to subsidiary company or subsidiary company to holding company, which are not regarded as a transfer, can such item be brought to tax under the book profit? So the court, while interpreting these provisions, so what they say, if any item which is of a which is in the nature of capital received, then it is not in the nature of income, which is defined under section 2, subsection 24. Then such item cannot be included while computing the book profit. Similarly, if the income which is exempt under section 47, let's say transfer from holding to subsidiary company, then such items cannot be taxed under even book profit. I'm not sure whether finally what the Supreme Court will held on this, but there's some judgment like in case of Ankit Metals of the Calcutta High Court, then Harrison's Malayalam Limited. So in the case of Harrison Malayalam Limited, I tell you what was the facts into that. In that, the company was holding an agriculture land, and that agriculture land was transferred. So initially, and the company has not considered the profit while computing profit on transfer of the land while computing the book profit under section 115JB. The tax department says that the gain from agriculture land is not a income from agriculture income as defined in section 1A, read with section 10(1). So they said that since it is a gain from, is not an agriculture income, so then it should be, so it doesn't fall in section 10. So the capital gain should be taxed, though the land was situated beyond the municipal limit and all. So that way it was qualified as an agriculture land for the purpose of section 10, subsection 14. Then High Court says that since the capital gain on such land is not chargeable to tax because of section 10, subsection 14, so it is not in the nature of capital asset, so the same cannot be brought to tax under the provisions of 115JB. So the principle, what the court has said, the capital receipt is not in the nature of income at all, so it cannot be included in the book profit for the purpose of computation under section 115JB. Then the interesting item, which is like when you compute so now anyway the 14A, because when previously when the dividend income was exempt, so then we were all supposed to compute the amount which is disallowable under section 14A, read with rule 8D. So item under 14A, then you have to disallow certain expenditure, and then you have to compute the amount which is disallowable as per rule 8D, which is a formula driven disallowance. So the question was whether such expenditure or such disallowance which is made under section 14A can be added back while computing the book profit. So initially the special bench in case of Virit Investment Limited, they held that expenditures relating to 14A, if those are not actually incur the expenditure but is computed as per section 14A or in accordance with rule 8D, such items need not be added back while computing the book profit. And then there are series of subsequently, then the Karnataka High Court has also held the same positions in case of Gokaldas Images and Britannia Industries, the Kolkata Tribunal. So they said that the expenditures relating to 14A, if those are not actual expenditure but are computed as for the purpose of section 14A, then need not to be added back while computing the book profit. So as I mentioned, while in the initial slide, when if there are provision for if any provision which is debited on account of diminution in value of any assets, whether such items is really to be added, or can a position be taken that this is not a diminution but is an actual write-off. So in this, I have just highlighted some of the decisions where the position or the court has held that if the diminution though in investment is debited to profit and loss account, but simultaneously the carrying value of such investment is reduced to that extent, so then it will be treated as actual written off, and such diminution is not to be added back while computing the book profit. So the Gujarat High Court in case of Vodafone SR, and again Karnataka in Yokogawa, and Kirloskar again the Karnataka, where they said that the book profit need not to be increased on account of such diminutions. But there are contrary judgment also where they said that these all are a diminution, so it's not an actual written off, and they said that it has to be added back if any item is debited. Then one item which I said that brought forward loss or unabsorbed depreciation in case of normal companies, like companies other than companies which are not under IBC, then the lower of the two is allowed as a deduction. So the question arises, how will you compute the lower of the two, which is as per the books of account? So first, the loss, as we all understand, loss doesn't include the depreciation. And if the amount of loss brought forward unobserved depreciation is, then nothing shall be. So when you have to break down the opening losses, and in that if there are no depreciation, or either if the loss, if there is no depreciation, so the loss is only the actual loss, then you will not able to set off. So there has to be, both item has to be there into the brought forward losses, then only you will get the lower of the two as a deduction. So now the interesting question is, since the accounting standard does not specify how the losses to be bifurcated, because when you look at the profit and loss account or reserves, then it gives a composite number, the negative losses. But in that, the account, there is no breakup. What is the quantum of depreciation and what is the quantum of a loss other than depreciation? Then the position which based on certain judicial position can be taken, how to compute the book loss. So I have prepared one table. If you can see this table, just to explain the position of the brought forward losses or unabsorbed depreciation. So let's assume that in financial year 1920, the company had incurred a business loss of 100. Then there was a unabsorbed depreciation of 90. Then the total loss was 190. Then year 2021, again, the company has incurred a business loss of 200 and unabsorbed depreciation of 80. The total was 280 and cumulatively was 470. And again on 2120, the company has incurred a loss of 300, unabsorbed depreciation of 60. The total loss was 360 and cumulatively it was 830. Then assuming in financial year 2022-23, company made a profit of 200 rupees. So in this case, if I add up the business losses, the total comes to 600. And if I add up the unabsorbed depreciation, the total comes to 230. So here the life is very simple. Then I can say, okay, my profit is 200. The lower of the two, 600 and 230, the lower is 230. Then I can set it off 200 fully. So there will be no book profit as far as financial year 22-23 is concerned. But now let's assume in the financial year 23-24, the company made a profit of 300. And by the time the accumulated losses are only 630 because I already set off 200. Then the question comes, what will be my allowable deduction of the lower of the two? So whether it will be 30 or whether it will be 140. So let me just explain how the 30 number has been arrived. So if I take that the total of my business loss was 600 and unabsorbed depreciation of 230, the lower of the two, I already set off 200. So what remain my unabsorbed depreciation is only 30. So will I be able to only set off 30 in 23-24, or do I have an option to set off 140? So how the 140 has been derived? So in year one, my total accumulated loss was 190, whereas I made a profit of 200 in financial year 2022-23. So I first set off the entire 190. Then what remain is 10. Then I say that again there is no method. Should I set off the 10 out of my business loss, or should I set off my first out of my unabsorbed depreciation? So in this case, I will follow a policy. I will first set off my business loss. So in this, I will first set off the 10 out of the negative 200 of 2021. So then what happened? My business loss will remain as 190 plus 300, which is 490, and my depreciation remain at 80 of 21 and 60 of 22, so 140. So can I set off 140? So the question is, will I be able to set off 30 or will I able to set off 140 in the 23-24? So again, there are two positions which are there based on the judicial precedent. So the first view is, as I said, 140, and this view is supported by the decision of the Bombay Tribunal in case of Binani Industries Limited. So where while dealing with this issue, the tribunal has laid down the principle and they said the provision of section 32(2) dealing with unabsorbed depreciation and 72 dealing with carry forward and set off business loss of the Income Tax Act explicitly provide for amount to be carried forward sort of in succeeding years, and they should be arrived at after deducting the amounts to which effect has already been given, which is absent while computing book profit under section 115 of the Act. Hence, for the purpose of computation of book profit under section 115 of the Act, every year the situation of list of cash loss and depreciation loss needs to be worked out and reviewed, and hence loss adjusted in earlier years is not relevant. So what they said, each year you have to see. So in this case, when, as I said, when we go to the 140 formula, then we have first we completely wiped off 190, and then what remain is 10 we set off against 200, so that the year 2 and year 3 losses remains as it is. So I will be able to set off 140. So this is supported by the Bombay decisions of the Bombay Tribunal. The second view is you can claim only 30 because you have to go on the aggregate basis, and then if you what is already set off, you have to set off minus it out from 1. So in this case, in the year 22-23, when there was a gain of 200, so first we have, because the lower of the two was the depreciation, which was 230, so we have already set off 200. So what is available on account of depreciation is 30 and business loss is 600, so you will get only 30. So this is the position which was held by the authority for advance ruling in case of Rashtriya Ispat Nigam Limited. But point is here, this decision was rendered in the context of section 115JA, and they have followed one board circular which was issued when the 115JA was in effect. So, and today we are dealing with the section 115JB. So the point is, so there are two issues which are there, whether one, AR ruling is binding on us. So AR ruling are binding on the assessee himself. It cannot be bind on the other taxpayer. Second, this was rendered in the context of 115JA. So can the same be applied to 115JB? In my view, the recent Bombay Tribunal has taken a position. So it is possible to take a view that in this case, the book profit of the 140 of the brought forward business loss, or depreciation, unabsorbed depreciation, can be set off while computing the book profit. Then there are certain other issues which are there, like if any adjustment if made while computing the transfer pricing, whether those items can be added while computing the book profit. So to that, there is a tribunal decisions which says ki no, TP adjustment cannot be made if while computing the book profit. So let's assume ki you file the transfer pricing report, and in the assessment, the TPO made certain additions. So because of those additions, can my book profit be increased to that extent? So to that answer is no, it cannot be added, because again, as I mentioned, that there is a mechanism which has to be added or reduced only what is provided in explanation. So you cannot brought anything which is not there. Then there was one decision of Chennai Tribunal where there were certain items which was there in the 26 AS, and the AO, while computing the normal income as well as the book profit, has added those income to the taxpayer's income. So the question was whether if any income which is reported in 26 AS be added to the computing the book profit. The tribunal in this surprisingly said yes, it can be added. So as I mentioned, the Apollo Tyre Supreme Court says the AO is not capable to recast the accounts unless it is certified by the auditor. But in this, the tribunal says it can be added back. Then one interesting issue was that if any income which is offered during the search can be added while computing the book profit. Again, in this, the Pune tribunal says no, even if it is offered to tax under search, but it cannot be added while computing the book profit. Then there was one position where like the assessee initially has created a security premium, and subsequently because there was certain losses, to reduce the carry forward of the losses in the books, the assessee has utilized the securities premium to clean up his balance sheet. So then he transferred the securities premium to unabsorbed losses in the book. So that's how the unabsorbed losses was reduced from the book. So then AO says that this reversal of securities premium ought to be credited to the profit and loss account, and reversal of such security premium is chargeable to tax while computing the book profit under section 115JB. To this, the Delhi tribunal in the case of Hindustan Coca-Cola has said no. If the reversal is the security premium is nothing to do with the computation of book profit, and it cannot be brought to tax. So then I'll just quickly cover up the items which are on account of the companies which are following Indian account Ind AS. So for like when we compute the normal computations under IGAP, so the starting point is profit and loss account. Then then there is a profit before tax. So we usually, while computing the book profit, we start with the profit after tax, and then we do certain adjustment. So for Ind AS companies, the question arises like from where will you start? So you will start from whether you will start profit after tax or the profit which are disclosed after certain on account of the other comprehensive incomes. So to that, the CBDT has clarified in the circular while computing for Ind AS companies, the starting point again will be profit after tax, and then you will make the adjustment on account of explanation 1, which are item to be added or item to be reduced, and then you will have to make an adjustment for the items which are there into the other comprehensive income. So like what are those items? So like the explanations to the 115JB provides like if amount debited to OCI that will not be reclassified to the profit and loss account, then you have to reduce it because it will never come back to the P&L account. So that effect has to be taken while computing the book profit. Similarly, if any amount which is credited to other comprehensive income and that will not be reclassified to the profit and loss account, then you have to add back because it will not come back. It will not come to the profit and loss account. That is why they said if such item is credited to the profit and loss, then you have to increase the book profit to that extent. Then amount debited to the profit and loss account or of distribution of non-cash assets, and these are all when there are M&A transaction on account of demerger, so that you have to make adjustment on this account. And also you are allowed to increase or decrease the book profit on account of any transition impact. So for this is only for those companies those are first time transiting from IGAP to Ind AS, and they have to quantify the amount of the transition amount, and whatever that amount which is quantified, which is a transition amount, that has to be claimed. Either it has to be added to the book profit or it has to be reduced from the book profit over the next 5 years period. And then the next item which need to be added is adjustment for gains or losses from investment in equity instruments measures at fair value in the year if they are disposal of transfer. And that is how the book profit to be used. After all this adjustment will be the book profit which will be chargeable to tax under the provision of section 115 JB. Then I will just quickly run through the circular which deal with the Ind AS, and then so the some questions which was raised before the CBDT, and the CBDT has answers to the questions which are relating to the Ind AS adjustment. So the first question is whether mark-to-market gain losses on account of fair value adjustment on various financial instruments recognized through profit or loss account, whether to be adjusted. To that answer, CBDT said no. Like, however, in case of provision for diminution, impairment in value of assets other than FTV, so if there is any impairment or diminution in value which is not which is in separate than fair value through P&L account, that has to be treated separately, because that for that the explanation clause 1 of explanation 1 will apply. Then the second question was, what will be the starting point for India's compliant companies? The answer, the profit before other comprehensive income, as we discussed, that the starting point for the profit before other comprehensive income, and then you have to make certain adjustment on account of items relating to other comprehensive income. Then the third question was computation of transaction amount on convergence date 1st April, or that is at the date start of the day or at the end of the day. So to that they said the first day of April 2016 for computation. So this was in the context of if the company is shifting from Ind AS for, let's say, financial year 16-17 is the first year of, then they said the 1st April 2016. Then the next item, if the dividend is debited to the profit and like proposed dividend for 15-16, which was recognized in profit and loss account in financial year 15-16, is required to be reversed and credited to retained earning for the computation of MAT, whether these balance would form part of the transition amount and thus be adjusted over a period of 5 years. Then to that clarification was adjustment of proposed dividend shall not be form part of the transition amount. I think these are questions when we circulate will be available. With this, I think I will ask Dhaval just to start on the new tax regime. So because now we will have the short time to that. So Dhaval, if you can start on the new tax regime.
Yeah, thanks, Gopal, for explaining the provisions of the old tax regime and the intricacies involved in the computation of book profit. Just 1 minute.
1 minute.
Yeah, thanks, Gopal, for explaining the old tax provisions and the intricacies involved in computing the book profit. Like a relay race, I will continue with the provisions which now deals with the new tax regime, which is very popularly called as new tax regime. Just to give a brief history before we go to these key highlights of the Taxation Laws Amendment Act, the finance minister had, made a comment that the corporate tax rate in India is quite high. But at the same time, there are many deductions and exemptions which are being provided under the statute. So to rationalize the same, it was proposed that gradually over a period of 4 years, the tax rate will brought down from 30% to 25%. With this, the Taxation Laws Amendment Act 2019 came into picture, whereby 2 types of sections, more particularly which is called as 115 BAA and 115 BAB, were introduced. as you see on the screen, as far as 115 BAA is concerned, it is applicable to all the domestic companies. And the effective tax rate is 25.17%. Those companies which are new manufacturing companies and satisfies the conditions, they are eligible for tax rate of 17.16%. With the companies who opt for these provisions, there is no liability to pay tax on its book profit. And simultaneously, the rate of book profit was also reduced to 15%. Now, as far as Section 115 BAA is concerned, to satisfy the conditions for availing the concessional rate of 25.17%, there are certain aspects while one has to keep in mind while computing the total income. So no deduction is eligible under 10AA, no additional depreciation for new plant and machinery or additions to plant and machinery. Then no deduction is available under certain sections which are 32AB, 3512, which is scientific research related expenditure, no weighted deduction. Also, you are not entitled to set off of brought forward loss or unabsorbed depreciation relating to the above sections. And no deduction can be claimed under Chapter 6A, except for three. One is 80JJAA, second is 80M, and third one is 80LA. 80JJAA relates to deduction for new employee deduction. So when new employees are employed, there is a accelerated deduction which is eligible. 80M deduction is of dividend declared against dividend paid, and 80LA deduction is against the profits earned by offshore banking units and international financial service center. One thing which is to be kept in mind that those companies who are opting for Section 115 BAA, they shall continue to be eligible for claiming 100% of the capital expenditure other than land on and building on scientific research. That eligibility is not been withdrawn. Similarly, the companies will be eligible for amortization of preliminary expenses, amalgamation demerger expenses, and VRS. Certain key points which one has to keep in mind is that before taking the decision, once you opt for this new tax regime, then you will not be entitled to carry forward the or set off the MAT credit. But at the same time, there is no time limit to avail the new tax regime. That means that you can continue to remain in old tax regime, use your brought forward losses, use your eligible MAT credit, and once that is exhausted, you can exercise the option for this new tax regime. But once the option is exercised, that option cannot be withdrawn. So one has to be very careful while choosing whether I need to opt or whether I not to opt for, and that will be based on the factual metrics of each of the company. So spatial rate tax will remain same like capital gains tax on listed securities. So all those spatial rate tax which are stated in the Chapter 12 will continue to be applied for computing the tax liability on such income. It is not 15%, but it will remain 10% for listed securities. Because the words used in this section are subject to the provision of this chapter. So whatever comes under Chapter 12, the spatial rates which are specified in this chapter will continue to be applied for. One very interesting issue is the unabsorbed depreciation, which is on account of additional depreciation, can be adjusted to the written down value as on 1st April 2019. However, the language says that the option can be exercised or it is available for such adjustment only for 1 assessment year, that is assessment year 2021, and not for subsequent assessment years. There is a writ petition which has been filed and which has been admitted by the Punjab and Haryana High Court on the principle of discrimination. So what are those points, a company should keep in mind while taking the decision to opt for this section? So there are brought forward losses, then company having huge MAT credit, companies which are entitled to take profit link deduction or weighted deduction. So one has to compute the tax position under both the regimes and try to understand which one is more beneficial. As I said earlier, that once you opt for the new tax regime, that option is available only once. The surcharge, which is, to be paid on the tax liability for all the income, is only at 10%. So all the incomes on which you have to pay tax, which comes under the tax regime of 115BAA, the surcharge applicable is 10%. Now, this is a table which gives the, basis of, comparison of the tax liability under this section as compared to the old regime, considering the turnover less than 400 crores and more than 400 crores. So as you will see, in the old regime, the tax liability is little higher as compared to the new regime. However, subject to, if there are certain deductions which the old regime you can claim, then that can be more beneficial. So a broad decision how to, take a decision is been just taken by way of an example. So tax break even for companies claiming specified deductions. Now net profit after common deduction for small size company is 100. Now specific deduction is 13.5 and 28. So net income is 86 and 72, on which if we apply the tax rate under normal, then it is 25.17 and 25.17. So this example just highlights that if you are entitled for specific deduction, then your net income after taking those deductions and applying the applicable rate will be equivalent to your rate applicable under book profit. So more the deductions or more the brought forward losses or higher the MAT credit, then to that extent, the old tax regime will continue to be more beneficial. It's a small case study where, a company is claiming deduction under section 10AA, whether it has some depreciation, brought forward losses and unabsorbed depreciation. So with business loss from business qualifying, then unabsorbed depreciation, unabsorbed additional depreciation, current year depreciation, and current year additional depreciation. So this is the position of, losses and deduction available for set off. The next slide gives a comparative of how it will work out for computing the income under the normal and the new tax regime, so that a company can take the decision whether it needs to opt for new tax regime or continue with the old tax regime. In scenario 1, you will say that the tax payable under the new tax regime is higher, and therefore the decision will be to continue with the old tax regime. But in the scenario 2, there is a possibility that to shift to second, that is the new tax regime, considering that the tax liability is lower. However, in such a situation also, one has to take into consideration the future deductions which may be available to the company if it continues to in the old tax regime. But basically, as I said earlier, that the general principle would be that once you have a brought forward losses and higher MAT credit, till that is used, you will continue to be more beneficial in old tax regime. This is another case study. Here is that what will be the basis on which the company can quantify the brought forward loss attributable to deduction under section 35 AD. As we see that the section says that whatever losses are attributable to certain deductions cannot be set off. Now the position is that in this case study, the revenue from business operation is 1 lakh, and after reducing the expenses, the operating profit is 25,000. And capital expenditure eligible for deduction under section 35 is 1,75,000. And therefore, there is a loss of 1,50,000. Now, what could be the amount which one can say that one has to ignore? So what out of total 1,50,000? There are three situations, which has one is that entire amount of capital expenditure is attributable to loss, or 75,000 loss is attributable to revenue expenditure, or loss is contributed pro rata in the ratio of 7:3 by capital expense as also revenue expense. Now, on this aspect, there is no clarity, but normally under the statute, one has to see which is the more beneficial provisions. The courts have held in many decisions that once there is a choice available with the SSE, the choice SSE can choose is what is more beneficial to it. There are certain decisions on that which are been there on the screen, which includes CIT versus Bosoto Bras, where strict construction is not required. Wherever construction is required in favor of the SSE, it has to be taken in the favor of the SSE. Similar principles have been laid down by the Bombay High Court and also by the Supreme Court. Even in these decisions, the question was of the set-off of long-term capital loss and short-term capital loss. So the decisions are primarily on the position that once there is a favorable way an SSE can do a set-off, that favorable basis should be allowed to be done by the SSE. So in principle, a proper view will be that since there is no clarity on this subject, whatever is favorable to the SSE can choose that aspect and take the set off. So in the example, what we were trying to analyze, if this is the case, then whatever is most favorable to the company, that aspect can be taken into consideration. This is another case study where there are SEZ unit, there is non-SEZ unit and non-SEZ unit 2. Today it is a combined company. So based on the existing structure, the tax rate is 34.94 and the tax payable will come to 12,229. An existing structure, if the company opts for the new tax regime, then the tax payable will work out to be 11,327. However, if there is a structuring whereby the non-SEZ unit 2 is being demerged, and then since both are separate companies, then under the SEZ unit and non-SEZ unit 1, the tax liability will work out to be 3,494, and in case of the resultant company, that is non-SEZ unit, it will be 6,292, and therefore there will be a tax arbitrage because the total tax liability will be 9,786. However, for taking such decision, one has to also take into other aspects of cost benefit matrix, such as the cost for implementation of the scheme. There will be a stamp duty incidence and also the commercial aspect including the SEZ rules, one has to keep in mind before taking a decision of restructuring the company into SEZ company and non-SEZ company. There is a practical problem many of the companies have faced, that because of error, they have not filed their Form 10IC. Now, the tax audit report is filed earlier, where it is mentioned that the company has opted for the new tax regime. In the return of income also, the computation is made as if the company has opted for new tax regime. However, by mistake, the form remains to be filed with the department. So there is a Bombay ITT decision where on these facts, the SSE, the company, has been denied the benefit in the absence of filing of Form 10IC. However, there was a petition filed before the Gujarat High Court, and the Gujarat High Court has said that the company can approach to the CBDT and condone the delay or condone the mistake for filing the form. So, however, the better view could be that this is a procedural aspect. Having disclosed that the company has already opted for the new tax regime in tax audit report, and also the return of income is computed or is filed based on this premise, it's a procedural lapse which should be eligible for rectification. However, there is no such provision which is provided in this section that this procedural lapse can be rectified. But at the same time, there are various decisions under the statute in the context of Chapter 6A deduction, in the context of charitable trust, where the courts have held that the audit reports are procedural in nature. They can also be filed in the course of assessment. So we hope that this liberal view is taken. So wherever the companies have not filed their Form 10IC, the better view will be that once they file it physically in the course of assessment proceedings, the same should be considered as due compliance of the law. Yeah. Another important point before we go to section 115 BAB is that what happens after opting for the new tax regime. There is some non-compliance in the next year, and the conditions which are stated in subsection 2 of that particular section is not adhered to. Like, for example, in the next subsequent year, deduction under ATG is claimed, though you are not eligible having opted for the new tax regime. So there is a proviso to the subsection 1 that it says that in case of any violation of subsection 2, so that means any violation of the conditions of that particular section will result into you opt or you will no more be eligible for that particular section for that year and the subsequent years. Though the section says that once you opt for the new tax regime, you cannot withdraw. But at the same time, if there is a violation in any subsequent year of subsection 2, then your eligibility is you are no more eligible for new tax regime, and straightforward you will go into the old tax regime. And having violated the condition, you cannot re-come to this section. So once violated, you will be opt out for this particular section forever. With this, we come to the new section 115 BAB, which is the tax on new domestic manufacturing companies. The conditions for availing this benefit of lower tax, which is 17%, that the company should not have been formed by splitting up or reconstruction of an existing business. Plant and machinery installed should not have been previously used for any purpose. So second-hand plant and machineries are not allowed. However, a liberal view is taken that plant and machinery which are in value do not exceed 20% of the total value of plant and machinery, they won't be considered as old plant and machinery. And you can also install imported plant and machinery, provided they have not been used in India. The manufacturing unit should not be set up at a building which was used earlier as an hotel or convention center, in respect of which deduction under Section 80 ID has been claimed. And you will not be entitled similarly any deduction under Section 10 AA or additional depreciation under Section 32(1)(1)(a). And similar to the provisions of 115 BAA, you will not be entitled for any of these deductions which are stated on the screen. Now, what are the important aspects one has to keep in mind for the eligibility of Section 115 BAB? The most important thing is that the company should be established after 1st October 2019, and the sole objective of that particular company should be for manufacture or production. Manufacture or production is a much wider term, and the provisions of 115 BAB has specifically provided that certain activities will not amount to manufacture, like software development, mining, printing of books, production of cinematographic film, bottling of gas into cylinders, conversion of marble blocks or similar items into slabs. These all are items will not be regarded as production or manufacture. However, at the same time, they have specifically stated that generation of power is manufacture or production. So one important thing one has to keep in mind, that if there is an undertaking which company is establishing for the purpose of generation of power, and that power is to be used internally, it is to be consumed internally, a thought can be made to have a separate company for the purpose of generation of power, which will be supplied to the manufacturing units of that particular group. If the specified conditions for any reasons are not fulfilled after the year in which it is opted for, then that particular company has the option to opt for Section 115 BAA, which provides for concessional rate of tax of 25.70. This is another important aspect one has to keep in mind, that between the associate enterprises, if there are any transactions, those transactions are subject to transfer pricing regulations. So all the intra-company transactions will be subjected to transfer pricing adjustments if they are not at the arm's length price. And any TP adjustment which has been made, that will be taxable at the rate of 30%. This transfer pricing regulation shall be applicable only to the company which opts for Section 115 BAB, not to the other enterprises which are associated enterprises of the company. It is only to the company to whom the tax regime is applicable under Section 115 BAB. In case of amalgamations, the condition which are prescribed under subsection 2 thereafter will have to be fulfilled by the amalgamated company. So provisions provides for an option to domestic company which is set up after 1st October 2019 and has commenced manufacturing on or before 31st March 2024. This date was earlier up to 31st March 2023, which was extended by Finance Act 2022 to 31st March 2023. Whether there will be any further extension, only time will say. An interesting question arises from this point, that if there are plans to incorporate a company to set up a manufacturing unit, but the time limit is, since it is 31st March 2024, can that company be set up and start a small manufacturing unit and commence the commercial production, and thereafter go for an expansion in that particular company, whether that company will still be eligible for this concessional rate of tax under 115 BAB? It's a question. But looking to the plain language of the section, it seems that it will be eligible, because the conditions which are to be satisfied for claiming this concessional rate of tax has to be satisfied on a year-to-year basis. One has to satisfy the conditions on a year-to-year basis, and hence, even if there is an expansion in the next year or year after that, the conditions of splitting up or reconstruction of business, the condition of having plant and machinery, new plant and machinery, all those conditions have to be satisfied on a year-to-year basis. Hence, a possible view could be that a company which has set up a small manufacturing unit and has commenced production will be eligible for this concessional section for all the expansions which are made under that particular company, provided all the conditions are satisfied. The section specifically provides that the income which is derived or which is incidental to manufacturing will be eligible for tax rate of 17.16%. However, those incomes which are not derived from, or those are not incidental to manufacturing or production, they will be taxed at 25.17%. However, on those incomes, you will not be entitled for any deductions or allowance available. That is all operating expenses relating to that particular income will not be allowed as a deduction. In case of income from house property, you will not be allowed 30% as the standard deduction. So as far as the new tax regime company is concerned, if it has any income which is not relating to the manufacturing operations, will be taxed on gross basis at the rate of 25.17%. Short-term capital gain on transfer of capital assets, where is no depreciation has been claimed, the tax rate is provided as 25.17%. As the special rate tax will continue to apply, so all those incomes which are subjected to tax under section 1112A, 115BB, etc., will continue to be taxed at the rate specified in the respective section. Subsection 5 says that you have to file the requisite form under subsection for furnishing the first of the return of income of any previous year. So option has to be exercised for furnishing the first of the returns of income of any previous year. Now, what does this meaning means? They have used the word furnishing the first of the returns of income for any previous year relevant to the assessment year commencing on or after 1st April 2020, and such option, once exercised, will continue for subsequent assessment year. In my view, the first of the returns means that the original return of income. It is not that once the company is established in a particular year, for straight away the company should opt for this new section. It can opt for in the next year also. However, it has to opt in its first return of income for that assessment year, that is the original return of income. What conditions to be satisfied? Now, as we had discussed earlier, the conditions which are to be satisfied, they have cumulative, and at the same time, they need to be satisfied on a year-to-year basis. So the company should not form by splitting up and reconstruction of business, not to claim the specified deductions as mentioned in the section, not to use plant and machinery, more than 20% use plant and machinery, and cannot be engaged in any other business activities other than the activity of manufacture or production of goods and articles. If there is any non-fulfillment, then the company can opt for the such provisions of 115BA and pay tax at the rate of 25.17%. A question can arise that a company gets its goods manufactured through a contract manufacturer. So a new company is being established. However, the requirements, that is goods, are produced by the contract manufacturer. It may be quite possible the entire raw material and everything is being supplied by the new company. However, the manufacturing facilities are not there with the new company. It has been outsourced from a contract manufacturer. Though it may satisfy the definition of manufacture or production, but whether it will be eligible for the concessional rate of tax, the answer seems to be no. The reason is that this section has been introduced to promote industry. There has to be an investment in new plant and machinery. That is the thrust of this section. So if you keep this objective in mind, then the new investment in plant and machinery is a very, very important requirement to fulfill for claiming the tax benefit or under this particular section. Section 115BAB provides for concessional rate of tax. So all these conditions are to be satisfied. So in my view, it will be difficult to argue that in case of a contract manufacturer, facilities are being used, still the company satisfies the conditions of 115BAB. There could be possible view that some of the process may be outsourced, but the entire manufacturing process to be outsourced, it seems to be a difficult proposition. Now the main point, that what is splitting up and reconstruction of business? It is not defined under the Act. However, this is a terminology which has been there in the statute in various sections, like section 80J, 80IA, 80IB, 80HH, and it has been a dispute matter, and the matter has gone up to Supreme Court. So there are two fundamental Supreme Court decisions which has laid down certain principles. The first one is the Textile Machinery Corporation, where it lays down the principle that reconstruction implies that the identity of the old business should not be lost. The existing business can be carried out even if the new undertaking ceases to function. Emergence of physical separate unit which exists on its own and it's separate and distinct, and investment of fresh capital. Another Supreme Court decision is in the matter of Indian Aluminum Company, where also similar principles are laid down. In broad, what one has to analyze and see that my old business should continue at its optimum level. Once the old business continues with the optimum level and the new company is on its own, it has to stand on its own legs. Then these are two separate identity units, and in different companies, they are running their own business independently. Then the term splitting up and reconstruction will not be hit. However, it all depends upon the facts of the case, but the principle which has been laid down by the Supreme Court, that both the companies should be independent, it should run independently, and the old company, the earlier company's business should not get reduced, it should continue to remain at its optimum level. There are other decisions also on this aspect. One is of the Bombay High Court, where the concept of reconstruction of business essentially rests on change, that is old versus new. The change ought to be constructive and the existing undertaking must continue to carry on the same business. So that is the most important thing. Now, these decisions were in the context of undertaking within the company itself. In the new section, there will be two separate companies. So both the separate companies have to run continuously on the same business, and there should not be any reduction in the business of the old company. Then one can definitely argue that there is no splitting up or reconstruction of business. There are decisions on the line that even if the same product is manufactured, there could be same customers also. But however, if both the companies are running at their optimum level, and in the new company, the investment is of new plant and machinery, then there should not be any reason to say that the new company has been formed by reconstruction and splitting up of business. This is the table which just gives the comparative analysis of the structure of the tax rate. So new manufacturing company, 17.16. The company which opts for the 115A AA provisions, 25.17. In LLP, it will be 34.94% and 39% in the case of an individual. However, if considering that after the profits are earned, the same have to be distributed to the shareholders, and considering the dividend tax at the maximum marginal rate, then for 15% company, the effective tax rate will be around 49%. For 22, it's 54%. And for LLP, it continues to remain at 34.94%. Now, another interesting question which arises, whether GAR provisions can be invoked if the arrangement is found to be only for the purpose of taking the tax benefit which is provided under section 115B AB. The answer is yes, because GAR provisions can be invoked if in commercial substance it is established that the new company has been formed only for the purpose of enjoying the tax rate of 17%. However, if one analyzes the GAR provision and reads with the conditions which are enumerated in section 115 BAB, then it seems that once an company satisfies the provisions of subsection 2, all those cumulative conditions, that is new plant and machinery, and most importantly, splitting and reconstruction of business, then it seems that the answer is that GAR provisions cannot be invoked, because those conditions itself are, in our view, that it is more like a GAR provisions only. Because the moment I am able to satisfy that the company is not split up or there is no reconstruction of provisions, then I think the conditions which are mentioned in GAR provision will not be applicable. This is a simple case study. So there is a holding company which incorporates a new wholly owned subsidiary. It transfers or leases its excess land to its subsidiary company and starts manufacturing unit with initial capital and new plant and machinery. So whether such arrangement can be considered as reconstruction or splitting up, the answer is so long as the subsidiary company stands on his own legs and the Hoodco company business remains at its optimum level, then good argument that there is no reconstruction or splitting up of the business. So both the companies have to continue to operate independently at their optimum level. Another case study is the holding company incorporates new wholly owned subsidiary for manufacturing with initial capital and new plant and machinery. Both company carry on business independently. However, both company have similar customers. Now, whether such arrangement can be considered as reconstruction or splitting, a view is that once again, the primary condition, what has been laid out by the Honorable Supreme Court, that both the entities should have its separate identity. They should run their business separately. Even if there are same customers, it doesn't mean that the subsidiary company has been formed as reconstruction or splitting up of the business of the holding company. Similarly, in this case study 3, there is a demerger which is done by the holding company with all its existing unit and assets and liabilities to subsidiary company. And subsidiary company was formed for manufacturing with initial capital and new plant and machinery. Now, whether in such a circumstances, whether it can be considered as reconstruction or splitting up of business. This is a important aspect because the demerger scheme, which will be filed before the NCLT, must be on the commercial aspect, the reasoning for demerging the unit from the holding company to the subsidiary company. The demerger cannot be only for the purpose of taking the benefit of the new tax regime. That is number one. Even thereafter, once the demerger is done and the unit gets vested with the subsidiary company, the principle of 80% of new plant and machinery needs to be satisfied. So after including the plant and machinery of the demerged unit, if the ratio of 80:20 is not satisfied, then subsidiary company will lose the option of new tax regime for claiming tax benefit at the rate of 17%. Therefore, the demerger scheme, what are the commercial reasons for demerging? Those will prevail in deciding whether it is a reconstruction or splitting up of the business. And even if it is not reconstruction and splitting of business, the condition of new plant and machinery still needs to be satisfied. If the demerged plant and machinery assets, since they are all second-hand machineries, if that quantum exceeds the 20% threshold limit, then the subsidiary company will lose the benefit of the new tax regime. Thank you, friends, for listening. Any questions? I will be glad to reply.
Thank you very much, sir. But there are some of the questions which have come up in Q&A section by participants. Should I read that?
Yes.
So first is whether any transfer pricing adjustment made on account, any secondary adjustment, will such item be allowed to be added or deducted from the book profits? Please advise. This question,
Yes.
I guess, belongs
Yeah.
to.
So as I mentioned, that if there is a transfer pricing adjustment, which is a primary adjustment, then the book profit need not to be adjusted on that account. But if it is on account of secondary adjustment, because there is an explanation to section 115GB where they specifically provided that the book profit will be increased or reduced on account of secondary adjustment.
Okay. Second is company is in first year during financial year 22-23 and turnover is below 400 crore. Is eligible for 25% of tax rate.
Yeah, it is eligible. Gopal, you need to answer.
Okay, so the point is if the company which is in first year and the turnover in the preceding financial year is less than 400 crore. So the question is whether it will be eligible for 25% tax or it will be subject to tax at 30%. So this is the situation where you don't know what is the turnover in the preceding previous year. So the view which can be taken, and I think the CPC is also processing. So the turnover for that purpose will be treated as a zero. And then, so since it is less than 400 crore, so though there was no year, the preceding year, there was no preceding year, and that there was no turnover. So you can presume that the turnover is zero, and then you can compute the tax at 25%. And this CPC is also processing while processing the return.
Okay. And I guess it is the last for the day. So the company who is opting for section 115 BAB needs to report as per transfer pricing. If it has transaction with an entity which gets covered in associated enterprise definition, then what?
Yes. So as far as section 115 BAB is concerned, it will be covered as a associate enterprise definition if there are any transactions with related parties. So basically, the transfer pricing regulations in this section is to ascertain that the company which has opted for this section should not earn profit more than reasonable. For that purpose, if there are any transactions with related parties, which are defined as associated enterprises under the Act, all those transactions will be subjected to transfer pricing regulations, and it will have to be tested as per the arm's length principle by adopting any of the methods which are prescribed under the Act.
Okay. I guess all the questions has ended up for the day. So being a coordinator for the session on behalf of organizing team of WIRC, it's my privilege to propose a vote of thanks to today's session speaker, CA Gopal Bohra sir and CA Dhaval Selwadia sir, who really explained us very complex subject in a very simplified manner. And Dhaval sir has given us a very crystal clear clarity on the new tax regime with the help of case studies on different scenarios and solution on various practical issues. Whereas Gopal sir has covered all the intricacies and nuances of the old tax regime, may it be applicability of MAT provision, case references, capital receipt, exemption, IGAP and index, all the circulars. And I'm assured that after today's relay session, no page has left unturned on the subject matter. And lastly, I propose my gratitude towards all the participants who has gathered here in great numbers, and WRC expect the same response in further events also. Thank you so much. With this, I declare this session is over.
Thank you. Thank you.
Thank you.
Thank you.
Thank you.